welcome mobile home park investors, real estate investors, multifamily investors, and others who see value beneath the surface to the latest edition of the Mobile Home Park Desktop, where I bring you the latest news and analysis about the mobile home park industry from my desktop. Before we dive into this week's episode, I just want to let you know that this week I will be launching a how-to series for people who are looking to learn how to invest in mobile home parks. So if you've ever thought about owning and acquiring and operating your own mobile home park, then hit the subscribe button to be notified when the first episode of the how-to series drops. The first episode will be focused on finding deals. So go ahead and hit that subscribe button to be kept up to date with the latest updates. This week we'll be focusing on another one of the giant mobile home park investors in the space, UMH. They are also the third largest publicly traded REIT, real estate investment trust. And if you're wondering what a real estate investment trust is, go ahead and take a look at episode 5 where we covered the definition of that. They, along with Sun Communities and ELS, are publicly traded companies. So they recently released their Q1 2020 earnings report. And we're going to go ahead and dive into that report and find out what we can about how UMH has been affected by COVID-19, how their collections are, how they're doing overall. All right, so taking a look at this earnings report. You know what? Let's just go over a quick overview of UMH. UMH owns 122 manufactured home communities in the Northeast. They have 23,000 developed home sites. And as you can see here, they're mostly located here in the Northeast. So one of the things I wanted to know from the report was how this region was affected by oil prices, as oil prices have dropped, since this is a big shale region here. So there is some discussion of that in the talk, as well as some shocking stats about unemployment across their residents. So I will now switch over to that. So this really jumped out at me, and this is in the question and answer period. One of the people on the call asked a question about, do you guys have any idea at present what percentage of tenants in your rental units are now unemployed? And Samuel Landy, the CEO, he said, to the extent we know, we only ask people what's going on, and I think we believe as many as 30%. So, wow, that was pretty shocking to me. 30% of their people in their rental units are actually unemployed right now. So how is this going to affect collections? Now we're on the section that deals with collections. Remember, 30% of their rental residents, they estimate, are unemployed. And this surprised me. Despite that, they still collected 94% of their April site and home rental charges, which is only 1% off of their normal April collection. And as of May, they said they'd collecting 64% of their May home site and home charges, as compared to 53% at this point in May 2019. So by the 5th of the month in May last year, they had collected 53% of their rent, and this year they've collected 64%. So they're actually ahead of schedule. And this question was actually asked of Sam as well. Like, with 30% unemployed, how is it that the collection rates have still remained so strong? So a point that Eugene Landy brings up in regards to why collections are still so strong despite 30% unemployment rates, it has to go back down to what the whole premise of mobile home parks and affordable housing. As you can see here, he points out that 3-bedroom, 2 baths rent for about $800 a month. And, there's just really no cheaper form of housing that you can get in the area. And so even though there's unemployment among their resident base, there's a strong incentive for their residents to do whatever they can to be able to stay in their housing units, because it provides the best option of affordability that they have in the area. So another point that Samuel Landy, CEO, brings up is that there are approximately 11,000 of their sites. It's 11,000 out of 19,000 are tenant-owned homes. And so the average site rent for a tenant-owned resident is $453. So $453 to live in a 3-bedroom, 2-bath home that they have if they paid off their mortgage. And again, that's, you're not going to get a more affordable price point than that in the area. So, I mean, I guess that's pretty good news in general in terms of this ideal of resiliency within the industry, that despite 30% of their renters being unemployed, that the collections have still been pretty strong. And so the other question I was really curious about was how their properties have been affected by, what was going on in oil prices. And so here, Eugene, I think it's Eugene. Is it Eugene? Yeah, Eugene Landy addresses it. He says, the oil and gas industry has also been hit hard during the crisis. Global stockpiles are full. People aren't consuming as much gas. And so that being said, the investments we made in the Marcellus and Utica shale areas continue to do well. But here is the signal within the noise. So this is the point that I think helps us to understand what's going on, because it's not just that, oh, it's okay, the mobile home parks or the investments in these oil regions are fine. It's the fact that for their particular portfolio, they believe that less than 10% of the residents are directly employed in the oil and gas industry. So I guess that's pretty good news for UMH. It doesn't necessarily mean that you should be investing in areas that are heavy oil and gas unless you have sort of a long-term view of what that looks like and you're properly sort of adjusted for that risk. But for now, it seems like UMH has been weathering that storm okay. So here's an interesting point Landy brings up. He talks about occupancy rates and he talks about expense ratio efficiencies. So he's saying once the communities that they own, once they hit an 80% occupancy rate, if water and sewer is not separately metered, if it's not separately metered, then they're going to be running at about a 50% expense ratio. But if it is separately metered, in other words, if you're taking the water and sewer and you're not adding in revenue on the revenue line and then adding in the expense on the expense line, but if it's all like direct bill or if it's just being taken care of outside of your normal P&Ls, then actually the parks will perform at about a 30% expense ratio. So this is a really important metric when you're looking to underwrite parks. When you're trying to get a back of the envelope sense for how much it's going to cost to operate your park, a lot of times we want a expense ratio as opposed to trying to create a line item budget to begin with. So we could see here that at an 80% occupancy, for a UMH at least, that they're either at a 50% expense ratio if you consider the water and sewer both as revenue and expenses, or a 30% expense ratio if these things are being separately metered and not as part of the equation. Here's some pretty good news. If you're a fairly large owner-operator of mobile home parks, take a look at the latest update here. This is Anna Chu. She's the CFO talking about the type of financing that will be available for the rental homes. So typically on those rental homes, they were able to get financing at about a 6 to 7%. So they were borrowing money at about a 6 to 7% in order to buy rental homes to fill up their lots. But now, after working with the different GSEs, the government-sponsored enterprises, and I think they're running a few test cases with the Fannie and Freddie and these other big agency lenders, and letting them know, or basically showing them, that having mobile homes as rentals is no different than an apartment building, and therefore they should be getting financing rates that are closer to an apartment rate. And so, in the past, they had to issue their own preferred stock in order to purchase the rental units. I'm guessing the preferred stock return was less than 6 or 7%, or what they were getting from the banks. But now they're saying that it's going to be about prime. So they're going to be able to take out debt on those rental properties, pay off whatever preferred stock that they had issued, and they're going to be able to get that lending at around prime, which I think is around, it's sub 4%, so 3 3/4, somewhere around there right now. So I mean, that's a great sign. That's a great sign that the lenders are starting to understand that these mobile home rental units can operate like an apartment and giving attractive financing rates like they might give to an apartment. That's going to make a big difference, because now that means now to bring in homes to do infill, if you get that type of financing terms when you're doing infill, it's going to make a huge difference in your overall return. The cost of capital is going to be a lot cheaper. Another point I forgot to make earlier is that UMH, just like all the other big, large mobile home operators, did offer a deferral program. So for people who were having trouble paying rent because of COVID-19 related issues, they could put off paying for a month. And out of 19,000 residents, only 80 people asked for that deferral. So again, that's a really good sign in terms of resiliency, at least for the mobile home residents that UMH has, that only 80 out of 19,000 asked for any type of deferral. Let's take a look at an overview of UMH one more time. So they have a total of 122 communities, 23,000 developed home sites. They're located in 8 different states. Currently, they're about 82% occupied, and their average monthly site rent is about $447. Their rental to ownership rate is about 32%. So 32% of their sites are actually home rentals. And their rental occupancy rate is about 92.3%. All right, and I want to end this week's Mobile Home Park Desktop with a introduction to this concept of mental models. And a mental model is basically a framework, is a way of thinking. And I think this is a very relevant mental model to apply when you're looking at real estate. And this is the concept of margin of safety. This is also, I think Warren Buffett called it the moat. And that is, whenever you're looking at any type of investment, make sure that there is a big enough margin of safety in what you're investing in. So in case there is some downside, in case things don't quite work out the way that you expected, there is some breathing room in there for you. And that margin of safety could be in the amount of reserves that you have before you start investing. The margin of safety could be in what's known as your break-even ratio, meaning at what level of occupancy would you still break even on your investment? So if your break-even ratio were, say, 65%, and you were buying a property that was 90% occupied, you have a lot of margin of safety there, because it would have to fall below 65% before you start to lose money. So again, I think mental models are a great way for us to think smarter, think better, and creating and thinking about the mental models to apply in your investing, I think is a great way to ensure that you make smart investment decisions. This is from Farnam Street, which is a great blog. Farnam Street it's all completely dedicated to mental models and how to think better about everything, basically. All right, well, thank you very much for once again joining me this week for this week's episode of the Mobile Home Park Desktop. As I said, stay tuned for the how-to series, which is launching this week. The first episode we will have is how to find park deals, mobile home park deals. And as always, if you like or found this content interesting, helpful, whatever, please like or subscribe. I really appreciate it. Well, thank you very much.